Welcome to Islamic Finance for everyone.
Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome back to Islamic Finance for everyone. When you execute a trade on your smartphone or adjust your investment portfolio, are you acting as a legitimate market participant, or are you accidentally playing a sophisticated game of chance? In modern financial discourse, the word speculation is thrown around constantly. Critics often argue that because the stock market involves high risks and unknown future prices, trading is functionally identical to gambling. However, Islamic economics draws an absolute, mathematically verifiable boundary between legitimate commercial risk-taking and the prohibited mechanism of Maysir. As an Islamic finance professional working across academic frameworks and real-world capital structures, I see retail investors and professionals constantly fall into behavioral traps that turn legitimate commerce into a casino framework. Today we are breaking down the anatomy of speculation. We will isolate the psychological and economic parameters that separate genuine investing from Maysir-like behavior. To understand where investing ends and gambling begins, we must look beyond external contract mechanics and study investor psychology. Let's recall the linguistic root of the prohibition of Maysir highlighted by classical jurists.
Linguistically, the term Maysir is derived from the root word Yusr, which translates directly to effortless ease. It structurally denotes the pursuit of Yasar, overnight wealth, without engaging in productive physical or intellectual economic labor.
This linguistic origin uncovers a major behavioral truth. The psychological driver behind Maysir is the desire for an effortless shortcut to richness. In modern behavioral finance, this maps onto a highly toxic mindset, chasing short-term, unbacked, extreme price volatility purely for rapid capital enrichment. When an investor stops evaluating the underlying performance of a company, ignores product utility, and acts purely on the addictive impulse of flipping paper exposures for an overnight gain, their behavioral tendency shifts away from commercial trade and mimics the exact psychology of a casino floor. The divine prohibition isn't just about protecting wallets, it's about protecting human psychology from the destabilizing illusion of wealth without work. Now, let's look at the hard economic engineering. What is structural mechanics that shifts a transaction from commerce into gambling? The answer lies in asset-backed reality versus synthetic exposure. When you engage in legitimate market trading, such as buying corporate equities or entering a musharaka venture, your capital is tied to real-world productive asset, business infrastructure, or human labor. This creates a positive sum game. If the company builds great products and expands, wealth is generated across society. In sharp contrast, Maysir-like speculation operates on the unbacked, synthetic financial exposures. The participant is not interested in owning or delivering an asset. They are simply trading the risk of a price movement itself. As established in classical jurisprudence, this triggers the absolute violation of qimar.
The core structural definition of gambling in Islamic commercial law rests on the maxim of Al-Ghunm bil-Ghurm, a transaction where one party's absolute profit, ghunm, is mathematically mirrored by and extracted directly from the counterparty's uncompensated, absolute loss, ghurm.
If you buy a derivative or speculative digital token that possesses no underlying utility or asset backing, no real value is introduced to the macroeconomy. You are simply betting against another trader or a seesaw graphic. Your win is their destruction. Legitimate trade creates the value. Maysir merely transfer capital through fabricated volatility. Let's address the ultimate objection face to face. Isn't investing in a high-risk tech startup or highly volatile commodity just like betting on red at a roulette table? The outcome is completely unknown. The answer is an absolute no. And understanding why will change how you manage your capital. Venture capital involves taking a high operational risk, khatar, but that risk is inherent to the process of human innovation. When an entrepreneur builds a company, the risk of failure exists naturally. By sharing that risk through equity financing, you help build an enterprise, create jobs, and advance technology. Maysir does the exact opposite. It does not fund innovation. It manufactures an artificial risk that did not exist before. Betting on a roulette wheel or trading a highly speculative unbacked binary derivative option does not build a single factory, pay a worker's salary, or supply a single product. It is a manufacture hazard engineered solely to exploit market probability. True investing shares natural operational risk to create societal value. Gambling trades synthetic paper risk to exploit your counterparty. As we audit our portfolio and navigate today's hyper-digital capital markets, keeping our transaction transparent and ethically sound is a non-negotiable skill. If you are committed to building clean, blessed wealth and mastering the deep mechanics of Islamic economics, take 3 seconds right now to hit that subscribe button. Turn on the notification bell, because in our next episode we are diving straight into the front line of modern finance. We are going to audit derivatives, option trading, conventional insurance, and crypto speculation under the lens of Maysir prohibition. Let's turn this into a live boardroom discussion. Comment below right now. To close out this critical second episode of our series, let's solidify our benchmark checklist to protect our wealth from the traps of speculation. First, check your psychology. Are you trading to back real enterprise value, or are you chasing Yusr, effortless wealth through overnight shortcuts? 2. Identify asset backing. Ensure your capital funds actual underlying assets, physical inventory, or genuine services rather than purely synthetic unbacked paper volatilities. 3. Verify the exchange metrics. Avoid zero-sum financial frameworks structured purely on Al-Ghunm bil-Ghurm, where your profit requires your counterparty's absolute financial destruction. When we anchor our financial portfolio to these structural realities, we move away from economic exploitation and step into true productive commerce. Thank you for watching Islamic Finance for Everyone. Keep your transaction transparent, your risk cooperative, and your earnings blessed. Share this content with your professional network, and I will see you in episode 3. Until then, Assalamu alaikum wa rahmatullahi wa barakatuh.
If you found this explanation helpful, don't forget to like, subscribe, and share this video with your network. Let's spread the word about ethical and inclusive finance. Follow us on social media platforms for more insights into Islamic finance.